Welcome to All Things Policy, a daily podcast supported by Pragati, a flagship media initiative of the Takshashila Institution. We're a bunch of policy nerds based in Bengaluru, and we like to bring a fresh perspective to Indian affairs and an Indian perspective to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Hello everyone, I'm Sarthak and I welcome you to one more episode of All Things Policy. As we record this episode, the Indian Rupee briefly touched rupees 80 mark against the dollar. And the Indian Rupee has been depreciating for some time now. If you compare India's currency or the value of the rupee at this point of time with January 1st, 2022, it has depreciated 7.2% against the dollar. In this episode, we are going to discuss the implication of all this. In fact, we are going to talk about how foreign exchange markets operate, what is the implication of a weak currency, should it be a matter of concern, and what should be the way ahead. Joining me in this episode is my colleague Anupam. Hi Anupam. Welcome once again.
Yeah, thanks.
Yeah, so before we start the discussion, I have a quick announcement. So the admissions for the September 2022 cohort of our graduate certificate in public policy program are open. And if you're applying before 23rd of July, you'll be eligible for 10% early bird scholarship. So yeah, if you're interested in public policy, please give it a chance.
Of course, we will be discussing things like exchange rate mechanisms, forex reserves of the RBI, macroeconomics, and how that impacts trade and the whole gamut of really interesting topics related to this. So if you find this episode interesting, chances are that you would like the course as well.
Yeah. So thanks for this brief intro to what the course is going to be. Yeah. So Anupam, yesterday, as we're recording this episode, the Indian Rupee
14 July.
Yeah, 14 July. The Indian Rupee briefly touched the rupees 80 mark. And Indian currency has been depreciating as against the dollar for some time now. So it might be interesting for us to understand how the value of a currency changes over a period of time.
Yeah, thanks, Sarthak. So as you mentioned, this is quite a dramatic drop. It was 74 in, let's say, the beginning of this year, and now it's about 80. I'm ignoring the decimal point for now, though it might be extremely important for traders and so on. I think for us, overall sense of where the currency is enough. So it has been depreciating, and it's useful to kind of understand why the exchange rate moves the way it is, right? And so there's some kind of explanation. Now, within that, I think you have to look at it like many people understand the stock market. Let's also understand the currency and foreign exchange market in that sense, right? Firstly, it's extremely interesting in the way that the forex market is, it's kind of set up. So the forex market is truly an international market. It operates around the clock because there are different currencies operating throughout, right? So there's buying and selling happening all the time. The volumes of transaction is crazy. I think what happens in an entire year in the stock market, the value, let's say in the US stock market, happens in less than a day in the foreign exchange market, right? So I'm forgetting the exact number, but I think it's something like between $4 and $6 trillion worth of foreign exchange transactions are done on a pretty much daily basis, right? That's just mind-boggling, that number. So that's the scale of the foreign exchange market. Now let's understand how this thing moves. As I mentioned, in the stock market, people understand that there are different kinds of movements and reasons behind that move. So, for instance, the minute kind of movements within an intraday movement happens because of purely sometimes random reasons. There's the random walk hypothesis, which says that you can't really predict. There's an error term, it goes up and it goes down. You can't predict, but there are other fundamental reasons, right? Long-term fundamental reasons. So I think the forex market is pretty much like that. If you try to understand why the rupee fell by 2 paisa today and increased by 3 paisa tomorrow, it goes into really technical realm, and you need complex models to understand it and so on. But I think for our understanding, from a public policy perspective, you need that macro picture, right? What explains the long-term trend and movement of a particular currency? And for that, we have to go into trade. So what explains the movement of a currency is purely trade, right? So think about the value of a currency exactly like the value of any other commodity, the price of any other commodity, which is purely, determined by demand and supply. So in that sense, it becomes clearer, right? So the price of the rupee is determined by the demand and supply of the rupee in relation to the demand and supply of the dollar. So what that means is, let's say you're exporting more than you're importing. Okay. And that would mean that people have to pay you, and people have to pay you in rupees. So let's say you're exporting more to the US than you're importing from the US. Then there are more US citizens who are selling dollars and buying rupees. Right. So in that sense, there is higher demand for rupee compared to the dollar, and therefore the rupee appreciates. Turn the tables around. Let's say you're importing more than you're exporting, then the rupee tends to depreciate. Right. So you see that the movement of the currency is purely determined by the demand and supply for that. This is kind of a simplistic explanation, obviously, but it's kind of easy to understand. So now you look at balance of payments of a particular country, and in India's case, for example, you have we generally import a lot more than we export, purely in terms of merchandise or goods and services. We import more than we export, and therefore the rupee tends to depreciate. However, there is a countervailing, there's a balance there, because we actually get a lot more capital inflow into the economy than what goes out. So this, I mean, in terms of foreign direct investment, FDIs, and portfolio investment, right? Or FPIs or FIIs. So we get a lot of that money. And even in that sense, the mechanism works in the same way. So if somebody wants to invest in the Indian stock market, they have to sell dollars, buy rupees, and they'll invest in the Indian stock market. And therefore, again, the rupee appreciates. So the end result is really the kind of balance, or the net balance between these two actions. So the sale and purchase of goods and services, and the sale and purchase of, let's say, other kinds of financial services. And the net between the two determines the overall kind of broad course that the rupee runs.
Yeah. So Anupam, at this point of time, since the rupee is depreciating, so what is happening right now? Are our exports going down, or the amount of investments that is supposed to come to India that is not coming? What is happening? What is the reason why you have this depreciation?
Yeah. So let's get into the current scenario, and the mechanisms is exactly the same, but of course there are global episodes which are determining this more than just what is happening on Indian shores. So I think the most important thing is that there is the war that is taking place, the Russia-Ukraine war, which is just happening after the pandemic. And so you take both of those together, there is a lot of global uncertainty. And we've seen the historical kind of episodes and experience tells us that whenever there is global uncertainty, or I mean in financial markets, whenever there is uncertainty, people always go to safe havens. We understand that, right? So in purely domestic markets, when people feel unsafe, they will go, and if there's a lot of uncertainty, a lot of risk involved, people will go and buy the most safe assets. And in India, that happens to be gold, that happens to be not for individual investors, but for companies and financial intermediaries, that will be government securities and so on. But in global markets, the safest kind of asset is the dollar. So you have this kind of large flow back to the safe haven that is the dollar, right? So people are selling off whatever assets they have in emerging markets. And this is not unique, or this is not confined only to India, but across the board, all emerging markets are facing the same thing. Investors are dumping whatever they have, and they're going back and buying US Treasury bonds and US Treasury bills, which is considered to be the safest episode. So that explains the kind of strengthening of the US dollar. To understand what's going on, you have to look at two aspects which are really the mirror image of each other. But just for analytical purposes, it's useful to just break this down into its separate entities. So on one hand, you have the dollar appreciating, and on the other hand, you have the rupee weakening, right? I mean, obviously this happens in relation to each other, but let's look at each of them separately. The dollar has been strengthening. So as we mentioned, there's a lot of global uncertainty. And in times of like the Russia-Ukraine war happening just after the pandemic, etc. So, and in times of global uncertainty, investors will flock to the safe haven, which is the dollar. So that is happening. And if you look at the dollar index, which is the comparison of the dollar against most of its trading partners, which is the major currencies of the world, the pound, the yen, the euro, renminbi, and others, Australian dollar, and so on, you find that the dollar is actually increasing in value against most of these currencies. So you look at, again, euro and the dollar. Usually the euro had a higher value than the dollar, right? And so I think it was 1 to 1.2, 1.3, something of that sort. That is, 1 euro would give you 1.2, 1.3 US dollars. So, but that is also flipped in the sense that I think now they're at parity, and in fact, the euro just fell slightly below the dollar's value. So that again tells you that the the dollar is strengthening because of historical reasons in terms of uncertainty. And we've seen this in the past as well. We've seen this in the 2013 taper tantrum episode. If any of you remember, just after the financial crisis, when there was again a lot of uncertainty, everybody rushed to the US dollar. In 2016, 2017, when there was a stoppage of the quantitative easing, etc., again, the dollar strengthened. And now you're seeing this again. Tied to this is, of course, what the Federal Reserve of the United States does, right? The Federal Reserve is the central bank of the United States. And you're seeing that the US Fed has been aggressively increasing its interest rates. So, one, people are going to the US for because it's safe. But on the other hand, you also are getting better returns, right? So the US is offering better rate of returns than probably most other places in the world. And that this is because the US Fed has been hiking rates. I think there's already, if I'm not mistaken, at least 100 basis point increase. And I think further, there's going to be quite a bit of increase as well, right? So because of these two factors, the dollar is strengthening. Now, we have to come to what's happening in India. In India, how you have basically a looming kind of you have a growth slowdown. I mean, this growth slowdown was there before the pandemic. Then the pandemic hit. The recovery is slow. It's not really showing signs of that V-shaped recovery, etc. It's kind of still fluttering, in the economy. So there's not a lot of confidence in the Indian economy at the moment. You add to it, of course, the fact that there is a rise in crude oil prices. I mean, this is both an impact and a cause. So you have global rise in crude oil prices, which means that you obviously import more. A larger import meal will obviously means higher demand for dollars. So you have to give up your rupees, get dollars, and then use that dollars to pay for oil. And so when the price of oil goes up because of these international factors, then the import bill goes up. And once the import bill goes up, then your rupee will depreciate. Right? So
Yeah.
you have a combination of these things happening. And so the rupee is depreciating because of a looming recession, because of higher crude oil prices. And generally, I mean, the economy not doing so well. And the US dollar is appreciating.
And Anupam, what about exports? How are the exports faring?
Yeah, so it briefly did well. If you remember, about 2 to 3 months or 4 months back, if my memory serves me well, the exports actually showed a lot of promise that it recorded quite high. It's purely talking from memory, but the thing is, it's not consistent, right? You could have a one-off kind of increase in exports, but the problem in such situations is that our manufacturing base is not strong enough to take advantage of weakened kind of rupee. So normally what would happen, and this is the normal kind of mechanism for reaching equilibrium again, is that you'll have, let's say, a depreciating currency, and that depreciating currency generally helps in exports, obviously, because
Yeah.
the items that you export is now more competitively
Competitive.
priced in the world market. And that means there is a higher demand for your products, which means there's a higher demand for your currency, and that brings parts. So this is a natural kind of equilibrium that should exist. But in India's case, even when the rupee depreciates, we are not able to take advantage of it. Our manufacturing base is not strong enough to take advantage of weakened rupee. And so therefore that our exports are not doing great, and the slide just keeps happening, right? There's no there's no brakes that are applied to this slide. So the other part, of course, is that the big problem for India is that we're so heavily dependent on oil as an input, right? And most of our input actually is increasing. There's rising cost of pretty much all of the the necessary kind of raw materials and inputs into our manufacturing process, which means that we are becoming uncompetitive as it is. So a combination of these two things means that our exports are not able to take advantage of the weakened rupee.
Yeah, so basically the exports are not doing well, which should have done well if you are having a weak currency, and on top of that, importers get impacted by it. And since oil is one of those major imports, which again feeds into different sectors in India, right? Transportation cost, everything becomes more expensive. So we need to think about ways by which this can be addressed, maybe, or maybe the government can do something about it. So we'll discuss this after a short break. And yeah. Welcome back. So we were talking about the impact of currency depreciation. So apart from the impact on exports and imports, any other impact currency depreciation has on the economy?
Yeah, I mean, back to the imports itself, really, but just to stress upon this that India is a predominantly, importing country, as in we always have had a trade deficit in terms of merchandise. We import a lot more than we export. And so, therefore, depreciation of the rupee means that all of our imports become more expensive. So, I spoke about oil, but that's true of pretty much everything else, right? And so that feeds into the inflation mechanism. So, we are already facing quite high inflation. And so, weakened rupee will make inflation far worse because, as I said, all raw materials kind of increase in prices, input costs will increase, which means prices of products ultimately will increase. So we are actually seeing this effect already taking place. A lot of consumer durables are far more expensive than what they were, let's say, in the beginning of the year. Supply chain problems are worsening because, again, things are more expensive. Some, inputs are not coming through as freely, etc. All of this is feeding into, again, longer delays, higher prices. And so you're seeing this impact consumers, the end consumer, quite a bit, right? You're also seeing, lots of other second order effects. So, for instance, I'm just taking one example here, but India's renewable energy projects, right? Whether it is solar, whether it is wind energy, or even EVs, etc., all of that again depends on imports because we import solar cells from China, we import even EVs and lithium and so on from other countries. So when all of this becomes expensive, it also creates a dent into our, for example, I mean, I'm just taking one thing here, but it makes a dent into our entire renewable energy project, which means again we rely more on fuel, which is the traditional kind of oil, and oil we know then becomes more expensive. So this is all, in
So
almost a vicious cycle of sorts, but that's how it operates, right? So how do you get out of this?
before going to that, so basically our exporters are not getting benefited because of the present circumstances. The end consumers are at the receiving end because they have to pay more for some of these things which are very kind of essential, I would say. So does that imply weakening of means loss of national pride or something like that?
Not at all. Not at
Okay.
all. So I know why you're asking me this question. It's almost you're trolling me, but it's important. I know I get quite riled up about this. The value of a currency has absolutely no bearing on the strength of the economy or the, I don't know, the national pride or how great an economy is or anything of that sort, right? Because I mean, it has no relation. It's just a number. I can give you lots of logical explanations as to why it shouldn't matter. But instead, let me actually give you through examples. The, if I'm not mistaken, the Azerbaijani dinar is more in value than the US dollar or the euro. Does that mean, what does that mean? Nothing, right?
Mm.
Similarly, so the South Korean won is far lesser. I mean, you compare it to
Yeah.
the, Indian rupees at 80, South Korean won will be something in, 2000 to something of that sort.
I remember long time back it used to be like $1 is equals to 1,000 won, something like that.
Yeah,
Maybe
yeah.
10
So
years
that's
back.
what the one Korean won is equal to 0.00075 US dollar. So I mean,
Yeah.
again, but that doesn't mean anything. Does it mean the Indian economy is better than South Korean economy? Absolutely not. Right? Japanese yen has always traditionally been quite weak in that sense. I mean, purely in that numerical thing. So there is absolutely no bearing of the value of a currency in absolute terms in relation to anything else, right? What is more important is the trend and the movements. So the fact that the Indian rupee has, let's say, depreciated 7 to 8% in 6 months, that is the more worrying bit. And then you have to ask why that is happening and so on. Now, as I said, there is a perfectly good example that the US dollar is appreciating Russia, Ukraine. None of it is in our hands. But there
Mm.
are a few of these things in our hands, which I think is going to be your
Mm.
next question. What can we do about
Yeah. What can the governments do about it?
it?
What are the
Yeah,
different mechanisms out there?
the government can't do anything about it or
Okay.
shouldn't do anything about it. Now, historically, again, the government, as in the elected representative parliament, democratic aspect of it, historically, they've not managed or actively managed the value of the currency. You generally find a higher correlation because of exactly what you said, right? About the the pride and so on. You have dictators, authoritarian leaders, etc., who get really emotional about the value of the currency, and then they try to intervene in the market by usually by going through something called the fixed exchange rate mechanism, right? You just fix the exchange rate at a high level, but that ruins the economy, right? That
Mm.
that causes unforetold kind of damage to the economy. most countries today, and I stress on most because it's not all, most countries today follow some form of freer market based exchange rate mechanism. Now, how free is the question? The IMF actually has 6 to 8 different classifications of exchange rate mechanisms. I won't bore the listeners with all of that. But on one side, you have, let's say, something like fully freely floating exchange rate, which is, let's say, the New Zealand dollar, the Australian dollar, Canadian dollar, the US dollar, euro. All of these are freely floating, right? As in nobody is intervenes in that market. On the other hand, the other extreme, you have basically no currency of your own. I mean, as in they don't even have a currency of their own, which is many actually European countries don't have a currency of their own, right? They have a thing, but even otherwise, things like Panama, for example, just uses the US dollar. The next stage is something like a fixed exchange rate. For example, Bhutan has a fixed exchange rate 1:1 with Indian rupee, right? The Bhutanese Nugultrung is 1:1 exchange fixed to the rupee, Indian rupee. Many countries are fixed exchange rate to the dollar, right? So that is India actually follows something called the managed float, which is that it's largely determined by the market, but the RBI keeps intervening. So when you say what can governments do, governments can't do anything. It's usually the central bank which can or should do something about it or shouldn't do something about it. But it's the central bank which has the power to intervene. And in India's case, the RBI does intervene now and then, but they absolutely maintain that they don't try to influence the overall direction or flow of the exchange rate, but they only intervene to provide stability. So you have to look at it from that Indian perspective. So what can generally governments do about this is, and so now when I say government, I don't mean the parliament government, but I mean the monetary authority, which is the RBI.
Central
What they
bank.
can do about it, the tool that they have is actually, things like open market operations. They have their own policy rate. They have, when I say open market operations, this is what they do, right? So let's say in a particular day, the rupee suddenly loses quite a bit of value, right? Let's say 0.5%, quarter of percentage point, etc., which is about 25 basis points or 50 basis points. That kind of volatility can hurt your traders, exporters and importers. I mean, imagine that you fixed a buying order, and by the time you actually have to pay, if the value of that goes up a lot, then it's that kind of uncertainty is not great, right? And the problem in India is that you don't have a lot of advanced, sophisticated financial markets to hedge against this kind of exchange rate risk, which is why the RBI feels the need to kind of intervene. Now, whether I agree with it or not is a different matter. I don't, but let's leave that aside. That's why the RBI does it. So it intervenes only to reduce the volatility in the currency market. So as I said, if the rupee is losing 25 basis points or 25 paisa, let's say in a day, then the RBI will just intervene. They'll buy rupees and sell dollars temporarily, so to just kind of stabilize the exchange rate, not to really influence the overall direction. So which means that it can't try to make it from, let's say, 80 rupees to the dollar to 75. What it will try to do is it will try to stabilize it from 80.2525 to 80.2520. That's what I mean.
Hmm. Yeah. So, Anupam, at this point of time, what do you think? I mean, is the Indian rupee overvalued, undervalued? What is it? I mean, as you mentioned, there have been the RBI, the central bank can intervene. So, at this point, what is the rupee's situation, status?
Yeah, I mean, I don't know exactly at this point. We'll have to wait for the data to come in. But up till quite recently, the rupee was, in fact, overvalued to the dollar. And so, therefore, we are seeing this kind of massive correction that is going on. So, that's not necessarily a bad thing, by itself. So, the rupee is just adjusting. And I think, again, don't make any financial bets based on my guesswork. But I think it's going to depreciate slightly further too, because the conditions are as such. What the RBI can do is essentially stabilize inflation at home. I mean, that is its primary target. It's not supposed to be worried about exchange rate at all. It's supposed to just look after inflation. Now, what happened because of that is that once you have, I mean, how do you tame inflation? You increase interest rates, right? And if you increase interest rates, then naturally you become slightly more attractive. On the margin, you become more attractive than, let's say, some other competitors or some other countries or maybe in the US, right? This is what brings about parity. And so you increase in interest rates, there'll be more people who will want to, let's say, deposit money in your this thing. NRIs might want to deposit money in your banks and so on. And so that'll kind of just stabilize things, right? And beyond that, of course, lower inflation already means higher growth. or better stability, and so therefore it becomes more attractive for foreign investors. So because of a lot of these reasons, if you tame inflation, chances are the rupee will stabilize on its own. The exchange rate will stabilize on its own.
Yeah. So apart from that, anything else that can be done differently or that should be done going ahead, right? Because again, currency depreciating implies your inflation has gone up, importers are at the receiving end, and also our exports have not picked up really.
Yeah, I really don't think they should be doing anything else. There are the central bank does have within its armory quite a few tools that it can deploy to stop this kind of depreciation, but it shouldn't, because whatever the RBI does, it's against. The way to look at this is in this fashion, right? RBI is one player in the market. If it tries to stop the rupee depreciating, then it is literally going against the entire market, right? And now we have to think whether that's a clever move. Now, what does it mean going against the market? It has to use the resources it has in order to, intervene. And what is that resources? It's the forex reserves. Now, the real question is, do you want to be using up your precious foreign exchange reserves to intervene in the market, which is going to be ultimately futile? It's not going to help. It can only temporarily put this thing, but sooner or later the market always wins, right? No central bank can fight the market and win. So it's a futile attempt. You're better off not doing any of those things. You're better off not spending foreign exchange reserves. Now, in between, they do a lot of other things, such as they block, for example, they put higher kind of tariffs and this thing on certain imports so that people import less. For example, gold always attracts some kind of ban or something so that people don't import gold, which will again increase the import bill. They can, for example, make it slightly more attractive for NRI depositors by increasing or giving higher rate of interest. So all of those marginal things they can try and do, which will again have marginal effects. But the big aspect is, don't waste your forex reserves in trying to defend the rupee.
Yeah. So with this, I think we can wrap up today's discussion. Thank you, Anupam, for such a detailed and lucid explanation of the exchange markets, the Indian rupee's depreciation with respect to dollar. Thanks, Anupam.
Thanks a lot, Sarthak.
Thank you to the listeners for tuning in. We'll meet again in one more episode of All Things Policy.
If you liked our show, don't forget to check out other interesting podcasts on the IVM network. You can tune into them on the IVM Podcast app, ivmpodcast.com, or wherever you listen to your podcasts. You can also follow IVM on social media. The handle is @IVM Podcasts on Twitter, Facebook, and Instagram. And hey, if you'd like to dive into Takshashila's research on technology, strategy, and economic affairs, check us out at our Twitter handle @TakshashilaINST or our website takshashila.org.in.